Hey folks, welcome to this conversation on Business Redefined. When Vida announced its management buyout, I was on travel, but because of the questions I have received, and of course, when Sam Kariuki crossed over to this side, I was the first guy to interview him. And when we talk about the D-REIT, we're the first platform to break that story. And here we are again with Sam. Karibu sana, Sam.
Asante.
Always a pleasure.
Always a pleasure as well.
So Sam, you have announced a management buyout. Of course, Actis was a key player in Vida. Now they are going off. Management is essentially taking the steering wheel, if I could put it that way. Maybe just bring us up to speed. Was this a factor of a life cycle consideration whereby as a PE their horizon was out, or it was strategically, we seem to be diverging, let's shake hands and say it's been real?
It's the natural life cycle of our PE fund. The PE fund will have a finite life cycle. So the PE fund under which we fall matured. And therefore, the exit was the natural sort of course of it. It was always part of the plan that at some point the PE fund has to exit.
What should we expect as market watchers? From a posturing in the market perspective, we have always known Vida to be characterized in a certain way in terms of execution of projects. Are you changing in one way or another, or do you retain the credentials as it were?
I think in the 7 years Actis has held the platform, it has invested heavily on the governance, on the systems, on the processes. We can only build on the pillars and the foundations that they've laid. We can only improve on them. But I'm very happy today when I look at the sort of institutional strength of the platform and the capital strength, to say that it gives us now a platform to grow it to a different level. Just to clarify, the exit means it's a shareholder level transaction. So all the capital invested in the business remains in the business. We've never distributed any of our retained earnings, so it remains intact in the business. And that sort of now gives us the firepower that we need to grow. We will strengthen the governance even more. We will remain an institutional, much as it's a management buyout, it will remain an institutional developer, because it means now we have capacity or an opportunity to bring on board other local institutional capital.
All right. And speaking about bringing in local institutional capital, when we sat back a while ago, you did indicate that Vida was intent upon going to market with a D-REIT. The ticket size at the time, from what you indicated, was about 4 billion shillings. Is that still part of the plan, and what sort of quantum would you be looking at now?
So in a way, fundamentally, it hasn't changed. I think what happened last year was the management buyout and the transaction, sort of from a sequencing perspective, took priority. So the better part of this year, we have then focused on the buyout and the transaction, which has now closed. The plan was always, because of the opportunity we see, especially on the affordable housing side of the market, the plan has always been to raise a fund of some sort. The initial D-REIT was to focus on affordable housing, and it was to give us what I would call our housing effect, in the sense that while you still pre-sell and sell as you construct, you would not be under pressure to sell 100% for you to ground break or for you to move ahead with projects. It would allow some in between rental, a period of holding, not long term, a short term period of holding. Then you can gradually sell over time and have a blended IRR that is acceptable to the market. That still remains in play. I suppose subsequent to this transaction, we can now activate that. It might be a small change from a structure perspective, where you have what I would call a hybrid development and income sort of a fund, a fund that takes some development risk. It has an income sort of rate characteristic from a yield perspective, but also seeks to exit the assets early to realize the capital gains and sustain a high IRR. That then means the quantum changes. I think the quantum you refer was, the initial target was to raise 4B. As pure development capital, that was sufficient. 4B can be levered to support a 20 to 30 billion development value pipeline.
So 5x thereabout. Yes.
Yeah, but the moment you then move to a fund that buys off our development platform, holds for some time and then exits, I think you're looking at a slightly bigger fund, from 15B to 20 billion or thereabouts.
That's not small, eh?
But the government has told us the deficit is 2 million units.
Yes.
So if Mivida can only do 10,000 of those in 5 to 7 years,
it's still a small
it's
piece
a
of the
very,
pie.
very small. And I think, the depth from an affordable housing demand is quite significant. The question has always been, how do you match developers' sort of capital characteristics, very impatient short-term capital, with the demand dynamic, which is very deep demand but for rental. So in between, you have people who buy from us as retail buyers to now, it's sort of savings allocation to hold and rent out. It's a limited pool. If you can bring a capital play that in a way supports the demand side by holding that for whatever period, then that addresses the core. But the fundamental in terms of the rental demand, I think it's validated. It's long-term and very deep.
Okay. Two follow-up questions there. One is that when you talk about the architecture of now going back to market, and you're talking about sort of a hybrid model with a high IRR, the high IRR in your sense is what? Is it the high teens? Is it entering into 20s, or how does it look like?
I would say high teens, low 20s. And I suppose if you're looking at local capital markets, somebody will always benchmark you to a similar dated treasury bond. So if you take a similar treasury dated bond as your baseline, then add some bips, 300 to 500 bips, I think it will be an acceptable IRR for the market because it's equally asset backed.
Okay. Yes. So the second follow-up question there is twofold. One is that in the management buyout, I was doing my own analysis not too far back, and I thought there must have been a debt component arrangement in it. Could you give us some color into that? And secondly, as you look to go back to market and capital raise, given how the yield environment is trending, we have seen one blue chip is going back to market to raise 20 billion. Was that an option on the table for you?
At that point, it was not an option. If you think about a typical management buyout, it's a structured finance. So it will have a component of common equity, who then management contribute. It will have a component of senior debt. It will have a component of what I would call a structured finance component, not MES per se, but something almost closely similar. So any management buyout typically will have those three buckets from a capital stack perspective. It's a structured finance play. So you're not very far off in assuming that then this particular one sort of followed that typical capital stack structure. And it means then, because if you imagine from the common stock to the senior debt to any mezzanine, each has different risk characteristics and different return expectations, then what you have is sort of a blended cost of capital from the transaction.
Okay. And based on what you have said then, I guess going to market with a corporate bond vis-a-vis what you are opting for just didn't, it wasn't compelling.
It wasn't compelling. And I suppose typically it's rarely that you'll go for a corporate bond to finance an acquisition. Yeah. People might interpret it. People want to invest in a corporate bond. You want to raise a corporate bond to finance growth. So to your question then, now that it will be a locally owned platform through Kenyan capital markets, directly or indirectly, I think it now gives us the flexibility as we now scale up the platform to start thinking of corporate bonds. I'm a strong believer in local residential platforms, sort of having a capital markets play or a capital markets participating in the residential play. Previously, you recall, we have raised a bond elsewhere. Still in the same place. I'm really convinced that there's a significant unexploited opportunity for residential in that interaction between residential platforms and Kenyan capital markets.
Okay. Players who have the character of Mivida in this market start off as affordable housing, but increasingly they're talking to us about student accommodation being a compelling pocket of the market. Is that something you're seeing? And then going forward from a scale perspective, do you retain the previous identity we have seen, or are you accelerating it?
So we will retain the identity. So I think Mivida will remain primarily a green, affordable, and mid-market housing developer. And that has been the core of Mivida. On an opportunistic basis, we may take on what we call high-end. Very opportunistic. It's where we see there's a demand, customers are asking, but likely to be very small-scale projects. Unlike our affordable housing, which today is probably 70% of the total portfolio.
Sam, you spoke about governance, and a lot of the questions I've received around this buyout is basically on that question. A lot of the PEs are normally prided to the fact that they bring in strong governance structures, which allows growth. Maybe just for people who are keen on Mevida, what reassurance can you give that even going forward, as now we are locally driven, what assurance can you give?
Thank you for the question. It's a really important question. I am proud that Actis has laid, as I said earlier, very strong foundations from a governance, processes, systems perspective. As we now transition to local ownership, we will definitely have local but strong, a local strong board. High profile, well-experienced business people bringing different skill sets to the board. So I think the exit can only strengthen the governance because you are working off a baseline that has already been set, and you're building on it to bring even other capabilities, other skill sets that were not in a previous board. So I would expect a stronger governance process, not a weaker one. As I said, we are keen that Mevida remains an institutional developer backed by institutional capital. And for you to get that backing, then you must maintain certain minimum levels of governance. And my belief is a business like ours should always have a governance structure that resembles a listed company. Like this fund we are raising, for you to be able to raise this fund, and that's like an immediate initiative, you can only do so if the investors are comfortable with the governance structures and standards that you have established. So I would expect the governance to actually strengthen.
Yeah.
Yes.
Yeah. And on the new fund, by the way, you haven't given us a time horizon. So are you looking at 2026, early, late, mid, or how is it?
So from Q1 next year, we should be now in the market, looking to start talking to investors on the fund. We're already at the early structuring stages and onboarding the people who will be working with us. So from Q1 next year, we should then start talking to local and also probably international potential investors, because we do believe there's a really huge opportunity that if you can sort of combine a development risk character with an income risk character and bring in a quicker capital realization, you are able to address the current concerns of income funds where the rental yields are perceived to be low, and maybe they are low relative to...
What do you mean perceived? I think they are low.
I say perceived because when I think to real estate, you don't just necessarily look at the rental yield itself.
Yeah.
I say perceived also because the rental yield is a real yield, unlike your typical bond yield, which is a nominal yield.
Yes.
For you to do like to like, you'd have to add the
inflation factor
to this, because the yield will always adjust with inflation. But that said, I suppose the other character is the underlying asset is appreciating in value. The challenge has always been, even for existing income funds, at what point do I realize the capital gains over the period for it to contribute to an IRR? So if one can then sort of structure a hybrid fund that's addressing both sides, then you're able to meet the market where they expect you to be.
And as imagine, even as you say that you'd be looking to court both local and international institutional investors, I'd imagine your skew is more towards local because, again, wrong way risk on FX has been a huge problem in this market.
It has to be a local currency play. Even if you're talking to international investors, they have to be comfortable with a local currency exposure. And I suppose as long as you're on the high teens, early 20s from a total return perspective, granted it then addresses their own sort of hard currency return requirements.
Okay. Don't you think your envisioned IRR is a bit aggressive, Sam?
I would argue, as long as your baseline is a similar dated bond. So if I'm raising a 7-year fund, I benchmark to a 7-year bond.
Yes.
And to it, you add some acceptable level of basis points, 300 bips for argument's sake, then it should be reasonable. Obviously, a local investor will expect you to give them something better than the bond, despite the underlying being a hard asset. And I suppose then it's a question of saying the 7-year similar dated bond plus what's that variable, what's that spread then in terms of bips that is acceptable to the market, especially for a first fund of its kind.
Yes. Sam, we have in the recent past seen you issuing keys to a number of investors. How is the market playing out? There's so much conversation around the macros and the implications it has. Many guys will tell you the macros are looking good, but from a micro perspective, we feel decoupled. There's no liquidity. Here you are dishing keys out. How is it going?
Good question. I think one of the things that has distinguished us is the ability to close on institutional bulk offtake deals.
Oh, yeah.
To your point, 2 weeks ago we handed over 200 keys to International Housing Solutions for a bulk deal.
Yeah, that's IHS.
IHS. Yeah. We are doing a similar deal in Keza now, our Keza Rerouter project. I think it will culminate in about 250 residential units and potentially others. At the same Keza project, we did a deal with a local pension fund, again for bulk offtake. So bulk institutional offtake are becoming to us a key channel that we are developing expertise and investing heavily on. And in a way, I think the fund we are talking about is speaking to that element. That said,
have you abandoned retail?
No, you can't abandon retail. You can't abandon retail. So retail will remain, strictly speaking, still the core of the business. And to your question, how do the macro dynamics play to the retail? If you profile your typical buyer, it's a person who's been saving for more than 10 years, 15 years or so, a middle-aged lady or gentleman who almost always is looking to reallocate part of their existing assets to real estate. It's rarely ever a new beginner. And much as we say, we may call ourselves maybe the homes or others are developing homes, strictly speaking, what we sell are investments. And our typical competitor is not necessarily the next developer. It is a unit trust fund, because that's the other alternative that Julian or Samuel have to invest if I'm holding some loose 5 million or so. Maybe the way to look at that question is to the extent that today the various unit trust funds or the various funds focused on the retail market are growing, and some of them are really growing aggressively. It tells you that saving class still have the liquidity, all the noise around the economy notwithstanding. The noise notwithstanding. And also, I strictly speaking haven't experienced the liquidity problem this year specifically. If I look at all the years in Mevida, this year has been the best from a collections perspective. One way I've looked at it is it's possibly because of the lower interest rates. As the interest rates are coming down, people have now shifted either now to buy new units, or those who had not paid up for their units have now shifted their capital back to paying up any balances they are holding for their units. But I haven't seen any liquidity squeeze, at least not yet.
But Sam, even as you talk about the institutional play as a key dynamic in your offtake, I'm curious because when I look at the pension assets industry analysis, real estate as a proportion is very small, and a number of pension funds will tell you, we tried it, we got banned. How are you flipping that narrative to be able to now bring them on board to what you're saying?
It's been how do I call it? A very interesting discussion in this market, especially pension capitals participating in residential real estate. One of the bigger challenges has been they holding a lot of illiquid real estate assets. For whatever reason, they hold land. They hold land, some hold office buildings which are not doing as well, either from a management or whatever perspective. And therefore the perception then has been we are already heavy or overweight on real estate. It's not yielding, so we don't want to participate more. My sense is it's exactly what we are doing that's supposed to be the solution to that. We don't believe pension schemes as a scheme should be holding illiquid real estate assets on their own balance sheet. They should be holding securities linked to real estate. REITs, for example, or the funds in this instance. And I suppose for them, as long as you're able to curate a product that meets their return objectives, not just from a total return perspective, but also from a liquidity, that periodically you are returning some cash to them in the form of a dividend or some form of interest or similar income, then in a way you're able to address what has been a historical baggage, if I may put it like that. I think pension schemes will be under a lot of pressure looking forward to invest in alternatives.
Away from fixed income.
Away from fixed income. And the rates are coming down anyway, and also they're overexposed in fixed income. It's not necessarily from an economic structure the most efficient way to hold capital, almost 100% in the public sector. I think they will be under a lot of pressure then to have a very good balance between the securities exchange, fixed income, and alternatives, which have a higher and probably a more resilient return. A real estate return, by its nature, is sort of resilient over a long period. A yield is a yield. Yeah. So I think in the long term, then it will work to the benefit of institutional developers who are able to bring to them securities that they can invest in.
Okay. Sam, as we dial down our conversation, Actis has been making a number of exits, including in this complex that we're talking about. Is the land we are sitting on part of the consideration you have?
So Garden City has a few more acres of undeveloped land, so Mevida will be taking over the balance of the land. You saw when you are launching the IHS project, we also announced a brand new project on 4 acres of Garden City land that we are looking to develop between 800 to 900 units. It tells you that Mevida has a vested interest in acquiring the balance of land from the sister company. This is our primary or our flagship site. We've been doing well from a sales perspective. The demand here is validated. It's a large 47-acre master planned development. So it makes sense for us to bid and acquire the balance of land because of that established demand on the site. So Garden City will remain our primary or our flagship development for a couple of more years. I think our total pipeline here is anywhere in the range of 2,500 residential units.
This area?
Yeah, this area. At different stages of, some have been completed, like 500 have now been completed and handed over. Another 300 or so will be handed over next quarter. The rest are at different stages of construction. So each year you can expect us to hand over between 500 to 1,000 units at Garden City in the next couple of years.
Speaking about sales, what's your typical pre-sale threshold as Mevida?
On policy, 30%. We want to pre-sell 30% to say the product, the demand is validated, the price point is validated, the product itself is demand validated, then you can ground break. The actual experience has been good. There's no project we've ground broken at less than 50%. In fact, some has been in the higher of 80%. Yes. In the best project we've done, at the point of groundbreaking, the deposit collections were at 70% of the total hard cost. So as you can see, it's a very customer-funded model. The risk sometimes with pre-selling is, so it's both a good and a bad thing. It's a double-edged sword. You pre-selling validates the product, it removes the market risk. But sometimes when you pre-sell and you still have 2 or 3 years of evolving development costs, you will then have fixed your revenue.
But costs keep escalating.
But costs keep escalating, so you then have to deal with it. So that's the risk. And therefore it's really a balancing act. It's a dancing act, some form of art that you have then to apply. At what point do I release stock to the market just to balance that?
But I'd imagine with inflation having moderated, it's given you a breathing space in terms of the cost escalation.
Relative to where we were, was it 2023?
2023.
It was terrible. Oh, it was terrible. And that's the time when we had pre-sold significantly up to that 80% range. Somehow now you had to manage around that.
How do you hedge against that, by the way?
I suppose, obviously, the beauty is even in any particular project, you have multiple phases. So you're not necessarily doing all the phases at once. It means even if your margins might be lower in a particular phase because of the cost dynamics, you're able to make up for it with your price escalations in the next phase, such that the totality of that project still meets the return metrics that the board had underwritten.
Give us your parting shot. And on your parting shot, I want you to focus more on the management buyout, Mevida, and the way forward.
I think this management buyout validates the investment thesis in our otherwise highly fragmented industry, that you can incubate a platform, you can institutionalize that platform and sort of develop it to an investment grade and successfully carry out a capital market transaction. It shows now this market has that potential to create similar platforms and even take them to listing at the Securities Exchange. I will believe our industry has matured when we start seeing similar platforms being listed at the Securities Exchange. It is an important aspect from a customer perspective because our market has also had a credibility issue previously. People taking customer deposits but not delivering units. the more developers become institutionalized and regulated, the more that moves away. People can now have the comfort that they're dealing with institutional businesses and regulated businesses, and the risks that we have seen before then are no longer a consideration. So from that perspective, then I'm very proud of this particular transaction. I've always been a big proponent of capital market transactions in our space because of all the various sectors in our economy. The residential space remains a very family office or individual driven and highly fragmented. We haven't had established enterprise type businesses operating in our space. And as we mature the various institutional players, my hope is that even the rest will somehow transition to this kind of transactions, either private equity type or even better for me, listed at the securities exchange. I think the local transfer of ownership from Vida will then allow it, now with local institutional capital, to grow a little bit more aggressively, as it were. As we say, the deficit is significant. It may not be in the millions that the government or other research shows, but certainly it's in the hundreds of thousands. And the population is growing. The demographic support our thesis on the demand, and for that reason, then I see us being able to tap into that demand with a little bit more flexibility, and with a little bit more flexibility to even take local capital. Obviously, when you're owned by a PE firm which has fully capitalized the business, the flexibility to tap into local capital market pools is obviously not there. Now, I think we are more open to local capital market pools, and I can see a little bit of that now playing as we look forward.
I know that was your parting shot, but two quick follow-ups from what you've said. The first one is, I take it that your new fund will be listed on the exchange. Maybe you can clarify that for us. And secondly, the reason why this market is as fragmented as you guys see is because a lot of us operate on mom and pop balance sheets. I don't have what Vida has, so I will do my small 2 floors. I get guys to come in, I get my rental yield, I scale it up. Don't you think it actually addresses market nuances that we should be alive to?
In a way, yes. And I think it's not very unique to Kenya or to even Africa. A lot of real estate residential still has that mom and pop characteristic, even in the more developed markets. But in those more developed markets, including South Africa, I think you see a lot of capital market participation that then allows the sort of scale that would prevent the sort of deficits we see in our market. The flip side, the other way to look at it is, even if local capital markets wanted to invest in what is touted to be a very good opportunity area like residential, we haven't had instruments at the stock exchange or securities that they can actually invest in. And I suppose then that is the challenge for us as institutional developers. Pension funds or asset managers will say, okay, it's a good sector to invest in, but show us the securities, show us the instruments that we can invest in. Nobody's bringing them to the market. Now that is our challenge, and which is why I'm very keen that we as a leading institutional developers should be on the front line of developing and taking to the market instruments that they can invest in.
And the first question was on listing the fund on the exchange, or?
Potentially we could. So we'll raise the fund. We'll then engage with the investors who come on board. That one of the best ways to exit is through a listing. The other way to exit, obviously, is the natural selling of the underlying asset. But the listing has an impact element as well, that you are sort of really incubating and supporting our capital market participation in an area that they have been very absent. And by that then, long term, you're able to sort of pull in a lot of other local capital market players into the industry.
Final one on your new fund. I presume you're already doing some book building, if I could call it, around these institutional investors.
Currently, we are at the early structuring stage. So we've onboarded our various advisors. We are at that early structuring stage. We'll probably use the balance of this quarter to perfect the various structural components. Then early from next year, we'll then go into the market and start re-engaging with the investors we get engaged in on the DRIT, but then broaden that base to even overseas investors.